The final video that I'm going to do for the Children's Place is on the operations. And I'm doing that because the operation for this company, if I hadn't spent time talking about the wealth creation and debt and dividends, I think that, and then the overview of the company, I think you might think that I was crazy for suggesting you should buy this stock. Because first, it's a retailer, and I don't really like retailers. And secondly, the operations aren't really sexy at all. In fact, they're barely above average. However, it's what happened with the dividends, the debt, and the general overview and wealth creation that's allowed me to overlook all that and say this is a better than average company that does really great things. And so keep that in mind as you listen to this brief analysis on the operations of the company. Here you can see gross margins. The green line is what I consider my desirable gross margins. It's what I like to see something over or and above. Now, if you look at the red line, that's my minimum gross margins. You should probably take me to the doctor if you see me buying stocks that don't have at least my minimum gross margin level, or at least a fantastic explanation for why they don't. This company is slightly below my desirable level, and worse, it's going the wrong way. So it's sort of slightly above average in terms of margins, certainly not exceptional, and by itself, I would rule this company out rather than buying it. So here are the earnings for the company, and you can see that they're not consistently straight up. They go up and down. They have obviously had a horrible year in 2007, but they righted the ship and have done well even through the recession. Things went kind of gradually down between 2009 and 2013, but since 2013, the company's done great. One-off year. Look, the fact is this company is solidly profitable, and the profits per share are getting better because we know the company's buying back stocks. So even though the margins are a little thin, the company is profitable, and that's one of the reasons we buy it, because it's relatively predictably profitable, and we know what they're going to do with those profits, and we really like that. So net earnings as a percentage of revenue, this company is extraordinarily average. It's really at about exactly about the 50% line. Again, this is not the kind of thing that would excite me about the company. But again, one of the things you should look at here is look exactly how consistent they are. This is rock solid, and I expect that trend to continue. And because I expect that trend to continue, I expect the company to continue to throw off profits, to continue to pay dividends, to continue to buy back stock, and in the long term, to enrich us as shareholders. We're going to get to the part of this company that really does disappoint me, and that's the 4 taxes. I talk all the time about there are these 4 categories of expenses that companies have, and every company has to spend some portion of the money on some or all of these, and it's how an efficient a job a company does at these that to a large degree determines how attractive a company will be. And this company is relatively unattractive in all these categories. So selling and general administrative, you can see that they're in the bottom 25% or just slightly better than that. That's an awful lot of money to be spending on general administrative, and normally that's the kind of thing that would disqualify my interest in the company if I didn't know so many other things about it. That is made worse when you look at plants and equipment. They are, again, very close to the bottom 25% in plants and equipment. So 2 of my taxes, they're in bad shape, right? Normally that alone would be enough to disqualify my interest in the company. There is a couple of things going on here that are reasonable. They seem to be relatively flat since about 2011. And with the exception of the last year, they had actually been reducing plant and equipment. I expect the reason it's gone up in the last year for plant and equipment is because of the Gymboree expansion. But long story short, this slide here, selling and general administrative and plants and equipment, are unattractive to me and might actually disqualify my interest in companies. However, it doesn't this time because of so many other fundamental things we know about the company. The good thing about this company is that it has no R&D. That might be its only saving grace in terms of the 4 taxes. It also has no debt, which helps. The next thing is inventory, and this company has way too much inventory. It's close to the bottom 10% in inventory, certainly below the worst of the top 25%. I understand why that is. I understand they're a retailer and their whole job is to possess inventory to sell people. And they need to have all that inventory on the showroom floor. And one of the problems with selling to kids is you need lots of clothes, and you need those clothes in lots and lots of sizes because people come in from toddlers all the way up. And the result is that you just need to carry a lot of inventory. But that doesn't mean that I like it, and it doesn't mean I'm giving the company high marks for it. So in summary, Children's Place is an exceptionally well-run and managed company, but it's in a tough industry. Retail, especially brick and mortar retail, is a very tough place to make a living, and it's tough to get the kinds of statistics that I look for in a company in that industry, especially when I recognize that my opinion is that mode of sale is becoming more and more outdated over time. However, having said that, I do believe that children's clothing is a unique place where parents need to see their children in the actual clothes because kids grow so quickly that it may be a unique industry that can thrive and will continue to be required to be a brick and mortar location. Number two, I don't think, generally speaking, being in retail is going to get easier. Even if you buy the concept that, parents need to take their kids out to an actual store to buy clothes, the fact is parents used to make a trip to the mall and kill multiple birds with one stone. And I think malls themselves are becoming more and more outdated, so it's going to be harder and harder to get the parents to come out. So I don't love retail, and generally, if I had all things being equal, I would avoid a retail company. However, the company has stable gross margins, but they are only barely acceptable, and they do not seem to be improving. That's a concern to me. But the good news is that only 2/3 of the company's revenue comes from brick and mortar. A third of their sales, 35% actually, comes from the internet. That trend I'd like to see expand. I think that if they can increase their online sales, they likely will lower their costs for those sales, which hopefully will generate more profits for us. The company's profits are generally increasing, and the profits per share are increasing even faster due to consistent share repurchases. So even, notwithstanding all the negative things I just talked about in the last several points, some of the companies manage to make more and more money each year. So maybe I should just shut up and take my profits, right? The net earnings as a percentage of revenue are extremely stable, and they seem to be predictable. The reason that that's really encouraging is this is an excellent sign. If they can continue to generate those exact same kind of gross earning net earnings as a percentage of revenues, then as they're able to increase their revenues through the recent Gymboree purchase, which should mean a new store within a store, it will mean a new website, and it'll mean some likely new locations which are replacing old Gymboree locations. That should be a significant increase in revenues, and if we can convert those revenues to the same low amount of profit per dollar, then those revenues will be excellent and create general profits for the company. Finally, selling and general administrative, as well as inventory and plants and equipment, are all too high. I'd like to see all of those reduce, but I would expect that to occur, especially in terms of the real estate, plants and equipment, as there's a general trend reducing the cost of retail real estate rents across the country for all the reasons we've talked about, the problems with retail real estate, brick and mortar, as opposed to inventory sales, as opposed to internet sales. So that's it for the summary of operations. The summary of operations of this company, if we in a vacuum, would not be enough to interest me, but because it's not in a vacuum, because we know so much else about the company, we're willing to overlook some of these weaknesses, and we expect to be profitable and even long-term profitable with this company. So thank you very much.